Happy Friday everyone, it's David here from prettypenny.club. In this video I'm going to be talking about my trading 212 portfolio. I've now invested somewhere in the order of £800 and I'd like just to talk through some of the shares I picked and why. It'd be interesting if you have any thoughts on this. You can leave your comments below. Let's get straight into it. Just remember that nothing in this video constitutes financial advice. This is for information and entertainment only. So here is my current portfolio. I have so far invested £796.10 for a return of £25.94. That's 3.26%. So let's just have a glance down what I have invested in. You can see Aviva, Lloyds Banking Group, Luckin Coffee, Persimmon, Seagate and the Renewables Infrastructure Group. So I'm actually going to start with Luckin Coffee. It's the only stock in my portfolio here that does not pay a dividend. Luckin Coffee are a big coffee company who are based in Asia, and they went public in May and they have already got 3,680 plus shops in China. So if you want to compare that for size, Starbucks have around about 4,125. So they're very much taking on the coffee giant here. I'm not sure they're necessarily in the same market, but we'll talk about a few differences there. At the moment, Luckin Coffee are not making any money. They have had a huge surge in growth based around a lot of funding, rapid expansion, undercutting Starbucks and heavily promoting new shops that have been opening. Starbucks, of course, on the other hand, are a very profitable company. But as I say, the coffee market is surging in China, and it's likely that Starbucks and Luckin are targeting somewhat different markets. Starbucks is very much a luxury brand, and Luckin is very much aimed at a younger market, where you can order online on an app and pick up your coffee from a booth or a shop. Coronavirus will certainly have stalled the growth of this company, and in fact I bought them, you may remember me mentioning in the previous video, just after they tanked. So I have been quite fortunate to pick them up at quite a discount, and you can see I've made quite a turnaround on that already. So the aggressive expansion and the uplift, hopefully in the near to medium term, means I'll be holding on to this in the meantime, but I'll be watching this stock quite carefully. I don't think the kind of aggressive expansion that they've been making is sustainable longer term, and from that sort of their tailwinds might begin to slow. As you can see, they did peak at over $47 there, slumped all the way down into nearly $28. That's round about where I picked them up. But as I say, I'll be watching that one closely because I have made some good returns in that. And I don't want to lose them as the growth stock loses momentum. As I say, I'm not earning any dividends on this one. It's only for growth. So the next share I'd like to talk about is Aviva. So you can see I've bought 23 shares in this company. So they are based in insurance, protection, investments, those sorts of financial services of around about 33 million worldwide customers. So in the last 5 years, the downside is that they've lost around somewhere in between 20 and 25%, as I say, in the last 5 years. And management are in the middle of overhauling its business, selling some parts of it off and trying to refine others. Their core product is undergoing something of a revolution. It is offering a fairly juicy dividend of around 7.5% at the moment. And that has enticed me to buy and hold this stock. Hopefully, if management can sort out the direction that the company should be going in, then hopefully the price could see decent growth if you're patient enough. And in the meantime, even if we tread water, 7.5% is a nice dividend to be pulling in for that one. The management have said they are committed to a fairly progressive policy. So hopefully those dividends will remain certainly in place in the near term. But again, this is another one I will probably look to keep an eye on. Similar companies in the market are probably doing better. Legal in General, which is on my watch list, is one that is in a similar kind of market, but the stock price is going up there for them, so they are growing. Not offering quite as good a dividend, but certainly their stock is moving in the right direction. So Lloyds Banking Group, you can see there, that's another one that has fallen around 25% in 5 years. Never truly recovered from the financial crash in 2008, but it's another one with a 5.5% dividend. Their earnings are greater than their payouts, so there's definitely room to sustain this. The PPI scandals and all the rest which hit the banking sector is largely over. So hopefully that's at least one positive going forward. Brexit is again through at least one stage now, and hopefully the improving economy, UK economy that we're seeing right now is good news for Lloyds as well. There's some analysts are predicting that a price of 78 pence is possible in the next 12 to 18 months. I think that's probably quite optimistic. But at the same time, I think there is room for Lloyds to grow even against the backdrop of an uncertain Brexit. And again, the dividend is nice, so even if we tread water with that one, we'll be getting a good return. Not without its risks, of course. They are very heavily tied to the UK, and if things start to hit the skids as far as the UK and Brexit goes in the next 12 months, this might be perceived as a somewhat risky choice. Persimmon is a house builder. They got into a lot of problems with customer services. They got a reputation for shoddy workmanship and very unsatisfactory builds. But that has improved recently. And certainly with the demand for housing in the UK, and no real sign of that being sorted out in terms of this particular government, there's certainly lots of room for Persimmon to grow. Dividend forecast of around 8% means that I'm quite happy to hold this. I mean, I think that's worth the risk, and as you can see, they are on something of an upward trajectory at the moment, and I think the outlook is pretty positive. Which brings me to Seagate. Now, this one isn't doing particularly well for me at the moment, but I've only had it for a few days. Seagate are an industry leader in the hard disk drive manufacturing sector. They have around about 45% market share for hard disk drives. Now, solid state drives are becoming very popular with households and domestic uses, but there is still a very high demand for cheap, huge storage. Seagate are in the middle of transitioning to new technology for heat assisted magnetic recording, which is essentially means it's 20% reduction in cost at an annualized rate over the next decade. So they are finding ways to improve the product. In the near term, hard disk drives are going to stay relevant. Again, probably going forward, it's one we're going to keep an eye on, but certainly the 5.5% yield on this is attractive while hard disks are still relevant. Very much a cyclical stock. Storage and memory for computers tends to come and go in waves, and hopefully we're on the up on this one. They do have some debts in the company, but they are in a better position than a lot of their rivals. So all in all, I think it's solid enough prospects for the near term. The final share I want to talk about is the Renewable Investments Infrastructure Group. Now, environmental issues are really coming to the fore. The International Energy Agency report published recently says that renewable energy capacity is set to rise by 50% within 5 years, and I definitely want a piece of that. The Renewables Infrastructure Group, I'm going to call it RIG from now on, invests in energy production predominantly in offshore and onshore wind farms and solar. And with that, the European market is very much a key metric for them. They are in a good position in Europe, which is very quickly surpassing the UK in terms of their uptake of renewable energy. They have already a foothold in that market, and they are progressing quite well. Dividend of 5.1% is definitely one for a long-term hold for me, and I would plan to add more of this stock as and when I can. So that is it. That is my round about my £800, well £796 invested. I do have £200 sitting in the wings, and I'm not going to make any moves over the weekend because I want to see how a couple of things went. But that £200 will be being invested in due course. If you have any suggestions what I should do with my £200, I'd be very interested to hear them. Leave a comment below if you have any thoughts on my stocks that I have at the moment. Again, love to hear your thoughts, so please leave a comment below. So that's the current portfolio on Trading 212. I do have other investments. I have a workplace pension, I have investments with Vanguard as well, and a couple of other bits and pieces rumbling around. But the Trading 212 is definitely something I wanted to get out there and share with YouTube. I also want to say thanks to everybody who has been subscribing this past week. I've been in touch with one or two folks who have let me know that they have subscribed. If you have subscribed, let me know. I want to get some conversations going. I want to talk about finance. I want to talk about passive investments. I want to talk about ways to save money, make money, so that we can all just get rich and literally do what we want to do with our lives.